Good morning, MMT. It's Saturday. It's 9:06 a.m. Pacific Standard Time, and what we are here to do is to examine once again our weekly update on the S&P 500. For my new free trial people and new MMTs alike, and people that will be watching these live analysis later in the day and throughout period of time, is we're below, for the very first time, this blue line is a 10-week moving average, and we're below it. Now, the bull trend for 2012, when we got up here, there was going to be a pullback, and Europe came in, and we had to sell short up here at the resistance. But we got down here in June, it was time to get long. This is where all the fund managers were never involved, right here in this video, right here where my pencil is on this chart, and they weren't. They were left behind because of the austerities around the world and the doom and gloom effect. But they came right back, and they kept that high frequency model across the board in the buy and sell transcript there within the broader S&P 500 stocks. They just kept going higher and higher, and it was all done in the cash futures markets that got them to these highs. But here we are again with the higher high of the year and the reversal. Now, let's make sure that when we had the reversal over here, this blue line is a 10-week moving average, and it flattened out over here. It went 1 week, 2 weeks, 3 weeks, 4 weeks below the 10-week moving average. We have a mathematical system on a weekly chart that we use. And basically, what I would like you to know is that the same thing here is we got 1 week below that 10-week. Now, the mathematical system that we use is designed to tell us where the weighting of the index is mathematically, and that equals bull and bear. Our systems are based on mathematical equations that are true and correct. What I will be happy to say is that unlike over here, the 10-week moving average is you got to get back above the blue line. It has to stop going down in value. This one isn't. It's starting to tip though. And you got to get back above the blue line for 4 weeks in a row. 1, 2, 3, 4 weeks in a row. And the 10 weeks started to point up, and we stayed above it. And the 10-week simple moving average was rising as we were climbing higher. This is called a calendar 2012. This is your first reversal of that bull. This is a secondary fall reversal from this summer seasonality that we had back in June. It was time to get long because you had too much support here at the 50-week, which is a pink line, 50-week moving averages. They did not want to break, and so the pullback was over here. And it met where the breakout started right here. So the breakout for calendar 12 started right here. Right here. Bam, that was your high. That was your resistances, and then they came back here. You can see where the test was. It's the same test of where the breakout happened. That's that part of it. Then, as we rallied up, we've got a left-hand side reversal again. Earnings season has not been well, as anticipated and forecasted. We told people that there would be a lot of havoc in earnings, that the market had a 4-to-1 negative earnings ratio, and you have to go back 10 years to find that, and that the current growth rate, the GDP numbers that were released on Friday, we think a lot of that is election related, because the amount of downside guidances and what CEOs have to say doesn't reflect those numbers. And that's a different story. But here we are at a major support level. This red line is rising still. It's a 20-week moving average. This whole calendar of 2012 movement has a lot of strength in it, meaning that bulls just don't disappear, but rather they have corrections, and it's a very strong S&P 500 reading. We are simply in the pullback phase. one of the things that we clearly had said, and I will draw this trend line again, is that we broke the 1425 handle, as you all know. Not only that, we got down to some intraday lows, which was 1403. How about 1390? I'll tell you what, the 20-week moving average, and I'm going to read what it is. It's 1403. That's the red line. So it's been climbing. Now, the low in the S&P 500 on a weekly level that we told people about was to watch that right above that 1400 handle. Right around this 1403, that was the low. It did not sell through it, but I will tell you that if we sell through it, that this S&P 500 is going to come right about here. This would be where we had the major wall of resistance. That would be 1367. Let's just call it 1370, all right? We'll use our other system to get the exact numbers and the delta ranges. Right now, it's a standard deviation weekly chart, MMT. That is going to be the wall of support. The bull will fight for that. They lost the 10-week, but it's only been below the 10-week moving average one major week. And then here you can see the body was below it. This is kind of flattening out. If it turns over and we start to undercut it, we would see increased selling within the S&P 500. Now, the month of October has not been very nice to people in a lot of stocks. They've come well off their highs as anticipated. And we had short a lot of them. That means that those downside corrections are tradable for profits to support levels. Where does the big money come off of here? They will start to sell below that 20-week. Right here. I'm just going to show this part of it. There it is. There's the 10. We can see it. It's clear. We can also see, though, that what was resistance over here, once it got above it, it's holding that support level. And it's bouncing off of that red line. Hold on. What was the major resistance here, where the breakout started, became that support here? A break below the 20-week, we're going to come down here. Now, the bulls that didn't participate, this is 1390. Well, here's where this little part will be, about 1391. Okay? Then we talk about 1398, right below that 1400 handle. It's all right in these weekly bars. I will tell my crew, my MMTs and everyone else, that we would look where if we break the 20 weeks, start next week. And remember, October is generally used to wash a lot of people out and have good corrections. And then you get that November turkey rally and you get your Christmas rally. The bulls definitely have enough strength to do that, but you have the election. Now, the markets are going to trade a certain way based on who wins that election, because you're going to have tax rates. Now, listen, if Obama's going to raise taxes, let's say Romney wins the election. Well, he wouldn't be sworn in until I think it's January 21 or the 23rd, something like that. They swear the new president in. But the Bush tax cuts automatically expire on January 1. So there are a lot of scenarios in this election that could play out related to the S&P 500 index on how it will trade. If people are going to get taxed higher and those things expire, it's better for them to do their tax selling now, or the big gains for what people have them. It's a good time to sell those now before you would have a tax increase. That's the Obama thing. So markets could see some selling pressure where normally you would have a rally just based on that one factor. And that's part of case A and B, or it's part of case B, which is the bear side of things, and case A is a bull. Now, let's talk about if Romney wins the election. Well, there won't be any taxes. And that would make the uncertainty. People are looking for hope, but if they vote for the wrong guy, they're just going to have another 4 years of misery. And I will tell everyone, if Mr. Obama wins, the first quarter of 2013 and the second quarterly earnings. So you got the first quarter and the second quarter. They're going to be very rough for about 6 months in these markets for the bull, should that case play out. And we'll bring it to you live, day by day, trade by trade, profit by profit. But I will tell you, and I will tell everyone again, to be very mindful of the mechanical structures within these markets of what would happen based on this election. And the thing about it is that who knows if the other party, you got two people to choose from. The other guy, he wants to make it where growth and broaden the lower base and bring the corporate tax rate down, everything that we've always said that needed to be done. If that man's willing to do it, then he's willing to vote for it. Or you can go with Obama. You can take a look at France. You can take a look at what socialism in the European model has done. It is a total disaster, and this is where Mr. Obama is taking this country, forward looking. And now is not the time to be raising taxes and capital gains. People make a living on capital gains and dividend yields. And if they put a tax rate higher on those capital gains or dividends, that shrinks profits, and markets are not going to like that. So the S&P 500 and the broader indexes are going to act a certain way. Case A is a bull for a new president with lower tax rates. That's case A. The S&P would rally up and take out 1475 and work its way up to 15 and a quarter, up as high as 1550 in the S&P 500. And I will show where that is. However, in the S&P 500, and the reason why this video is a little bit longer for my MMTs, because we have a lot of people that aren't in today's training that will be watching it. And they know what I say will happen. And right now, you're caught between the 10-week and the 20-week at support and the 10-week at resistance until you get a close above it for 4 weeks. It has what we call a bull. It's not a bear trend yet, but it's not going to be a full raging bull until you get 4 weeks back above this line. That's the 10-week. On a closing level, you will have to have 4 weeks above that blue line. MMT. The trading ranges, when you go below it, there will be more people that would sell, but the bulls that were on the sideline that were not involved, mutual fund managers underperforming. Hedge fund managers, 89% underperforming. There's only 11% outperforming. But the broader people involved did not get involved in this last rally because nothing makes sense, and because of the uncertainty and because of all of these things that are going on politically and worldwide events have kept people on the sideline. And they are losing the moves. Here, we take the markets for what markets are going to give, and we have a case management scenario A and B and C. And whatever direction that they're going to go with it, we're going to make money with it. So if the problem with the fiscal cliff happens, we've got more business leaders in today's world, CEOs, drafting letters and sending this to Congress, and they're reaching out and telling these people, this is what you need to do, this is what you need to do. And these are some of the biggest CEOs that run corporate America. And they're petitioning Congress. So when we start getting in, I can tell you there would not be a Christmas rally if Obama wins, because people are going to sell. And 2013 will be weak for the first 6 calendar months for the bull. There will be bear trades and bull trades. It doesn't matter. The trend will be the dictator. The high frequency models will leave and go to the other side of the tape. And when you're in a strong bull, it takes a long time for it to go into a bear again, but it is possible that this happens based on the election. Key support level, I've given the numbers out. We have broke some of the numbers. It's a, weekly reversal in a bull trend, but there's more to it because of the political situation. Now, let's go back over here. Let's take a look if Romney wins. Let's just take a look over here. 2007 highs over here. 2008 highs. When I said you could come up, you could come right up to the crown top of where the whole mess started. Can the markets get back to that level? They can. If the people on the sideline know that they're safe, they'll come off of that sideline. And let us not forget about Ben Bernanke. And when I talk about the S&P 500, it is the same relevance to the Dow, to the NASDAQ comp, NASDAQ 100, and other key sectors as well. Here is 1505. Here is 1482. When we got to the 1475, that was our short-term target, and we rolled over, and we've already got down almost. A good correction would be 1475 down to 13, let's say 1365 area. 1370 area would be a 100 handle reversal with any normal bull would have a 100 handle reversal in S&P, but would create a buying opportunity for those who did not participate and were left behind. And we do know with the FOMC, QE3 is not going to have the same effect that they always had, but you can't fight the Fed, and you can't fight worldwide Federal Reserves around the world pumping, massive liquidity into the system. However, you can pump all the liquidity in there from QE3, but if Obama wins the election, this market is going to need all of that. Ben Bernanke is talking about stepping down in January because people don't like it. Actually, QE3 is much worse. We've always said that. It doesn't help what this time around what people think. That's a different subject. So if we can get to here, this is going to be the major area. This is going to be 1454. It's going to be right here. We got to get back above there, this area. This is the area 1482 right here. If we get a good new change in tax reform, small business reform, confidence coming up, uncertainty going away, we can come back up here in calendar 2013. Our target would be 1550. We have different targets, but the 2013 target's going to be 1575, and we could even actually go up here and break 1575. We could probably get up toward the 1600 handle. However, it's going to be up in the air, and it'll be within a week or so. Which side of these markets are either this whole bull run that we've had right here is at jeopardy? Because I can tell you that the next two quarterly earnings would remain very weak and growth would still remain very contracted. The Bush tax cuts are gone. Everything is gone. That's when you can lose the bull. You can lose this whole bull right here. If the people on the sideline that are waiting to get into the market, they've got a chance to buy now. And they got a chance to have that money working for them in good quality S&P 500 companies, because you do. I will tell people it's a very crucial moment in time right now. It's probably one of the most important elections that we've ever had. The stakes are that big, because I can tell you why. If we get any terrorist activities as well to go along with the new hike of tax hikes and terrorist activity, this whole bull is at jeopardy. It's still a strong bull for the calendar yearly chart, but it's at jeopardy. We will update you if we sell below it. We're looking to buy the dips. If Romney wins, I can tell you up front right now, we'll be doing a lot of index trading on the S&P 500. There's a lot of money to be made here. So if we can correct and get down to the lower support levels and we get a change, we're going to be buying what? I will show you. We will go here to what we call turbo options. Let's see if I can get my chain to pull up. It's updating. This is called the S&P 500 options change. Calls is when the S&P goes higher. Puts People buy when S&P can go lower. These are weekly contracts. The ones that we would be looking at, though, would be the December year-end trade. If we come down and correct, what we would be looking at is up and out of the money, 1450 call strike price, 1222. Now, unlike the S&P 500 chart, these are the kinds of things that we would be setting up in this option tree. Number one, to hedge our portfolio. Number two, to be on the right side of it, up and out of the money. If it's cheap, as it is, because we've had a good little pullback, they can get cheaper. But once again, if there is a change and the fear and the uncertainty leaves this market, this S&P rallies up, and these calls pay a lot of money. A lot of money. Now, let's do this. Let's go back over here and say that Romney doesn't win, and Obama does, and you're going to have all of these tax burdens. What we would do is take a November, and we would be looking right here at this $1,400 put. Had 8,800 contracts traded. So when the S&P falls below 1,400, these go up in value. This is the side that would pay. So we have case A and case B. And I just want to emphasize that within every bull or bear rally, we know that there's lots of money in the S&P 500 index, and we're a master at that. So when you take a look at the put side, and you take a look, if you break this 1,400 level and you get below that 20-week moving average and you come down to 1367, 1370, that's a pretty decent gain, and it would go a lot lower. And another thing, if he wins, what we would be doing is we will go out to next year, and we'll go out to something like February. No, actually it would be March. And what would we do? We would look at buying this one right here. It's a 1,000 put, 400 handles below the market. Let me tell you what, the first quarter of 2013 would be very ugly for the bull, and these would go up in great value. Do they ever have to get to 1,000 on the index? No, I never said that. It's a premium trade. But if the index is going to fall another 100 handles, these are going to go up in value. If it got really dirty and nasty, because we have the wrong president in there and we have lower growth, the S&P, the bull, will cave in. So we got to look at various scenarios. Another one is the 1,200 put for March. It's 1580 by 1760. These are the volumes. Here is the size and everything in here. But we would be looking at various scenarios based on a very unfavorable business environment, meaning that we would be looking at various put options and call options. Because if he gets going, well, we could go right over here and start buying the $1,500 call way up and out of the money. It's 2,500 handles above the calendar 52-week high on the S&P, and this would be a great premium trade, and it would go great in value. And I will be bringing up with my MMTs on all indexes that the very same analysis that I'm saying here on the S&P also applies on all the other key indexes. So if I'm looking at a $1,200 put, let's say, I'm going to go over here and I'm going to pull up a chart and see if there's any data. There isn't really any volume traded on that one. But let's go where the open interest is. And let's take a look here and see exactly what this one would look like. We have some data here. It doesn't trade much. They're up here. They were up here. Wow. That 1,200, well, let me get the data down here. It's down here in this bracket. This is a weekly chart. So I can use a calendar daily chart. Let's try that. We'll probably get a little bit more data. We're not, because these are very far, they're in March. But we can go to February. Let's go to, or let's just take a look at the January 1280 put. Here it is. These puts were cheap at $8. They're up here at $14. And they've already made a great move off the bottom. That's the put side. Now, it's inflated, meaning that it's ready to come down short term. But let's take a look at a January. Let's take a look at a January call on the S&P. And let's go to 1475 right here. The reason why we like this one, because they were $40 over here, up at the high here. And most people that trade options, I'm a market maker in the pit, period. And we have a system that's not your regular option trading system that you know of and been studying. No, ours is quite different. I will say that this is deflated. It's not inflated. When they get inflated up here at $30 a contract, so for me to buy up and out of the money 1475 call is in my favor because the correction in the calls are down at their all-time lows. They've never been this low. Therefore, my entry, I've taken out all of the risk to have that upside move based on what this election will bring or not bring. And if it gets run the right way, these contracts, we get the right scenario, we'll be buying these. It's a January 1475 2013 call that could come right back up here to $30. But nonetheless, if we don't get the right president, none of this works. We've got great opportunities set up here on the S&P 500 because we do. Right here is a daily chart of the S&P. I know it's a long video, but this is my mid-year update for the presidential election. So my MMTs asked me to go the extra yard and really put this together for them. They can see that 1400 handle that we come down here. Now, if we break it, that 100-day moving average and the 200-day moving average, which is on a daily, is roughly at 1377. That's the 200-day simple moving average. The 100-day moving average, that's key. That's 1396. Technicians, standard technical analysis freaks, will be looking at it. The thing about it is, if we come down and test it before the election and he wins, we'll be buying it. Here's 1375 on the S&P right here. And that's where this big daily bar of the rally started on this daily chart. We got it very clear to those highs. That's the breakout. Okay? That's the major support level. If we break it here and we break below the 100-week or the 100-day, you got the 200-day down here, and that's where people would look at getting involved in the S&P 500. Here it is. Obama versus Romney. Romney versus Obama and the S&P 500.